Hello, and welcome to another episode of the Awesome in Seattle podcast. This is Christian Nossum of the Awesome Nossum Group at Wilson Realty. And today I have a very experienced guest and a very special guest. I have Varun Jain, who is the newest member of the Awesome Nossum Group, and he's also an experienced real estate investor. Varun, thanks for joining me, man.
Yeah, I'm excited to be here. Thanks for having me and happy to be a part of the team.
Yeah. This episode is cool because whether you're a new or a seasoned investor, we are going to be reviewing 3 very profitable investment strategies. We're going to go over house hacking, which we've done numerous times, but Varun has a different kind of twang to it, which is kind of cool. We're going to go over live-in flips and then DADUs and how a DADU can potentially supercharge your live-in flip. So we're going to go over all of this today, and it's going to be a very jam-packed, awesome episode. So stay to the end. You're going to learn a lot. So Varun, let's kick things off with house hacking. You have a couple of higher-level ideas on how to maximize a house hack. But before we get into that, let's go over the basics of what a house hack is. Can you just quickly define that for people that maybe don't know already?
Yeah, house hacking is a strategy where you buy a house either with multiple units or a bigger house with multiple rooms, and you rent out those other units and rooms to potential tenants. That lowers your cost of living. And those could be short-term rentals, medium-term rentals, long-term rentals, however you like it. But yeah, essentially you're renting out part of your house.
Yeah. Basically, you're getting rent from part of your structure, and that's decreasing the amount of pocket or out-of-pocket expense from you.
Right. Your mortgage payments.
Exactly. Yep. Exactly. Perfect. And if you want to learn way more about the basics of house hacking, check out episode 88, How to House Hack in Seattle. It's one of our most popular episodes out there. It's been out for a while now because we're on episode like 130-ish or something. So it's a little ways back, but it's still very, very up to date on what's going on. So why, in your opinion, is house hacking so relevant in today's kind of economy?
Yeah, so we've seen interest rates go up significantly. House prices continue to climb, especially in a market like Seattle.
Yep.
And so house hacking provides anyone the opportunity to own a larger house or a duplex, triplex, or a fourplex while subsidizing cost of living. And it works because, again, as we mentioned, it offsets part of your mortgage payment and lowers the cost of living. So you could be living in a larger house or a fourplex for the same cost of renting or buying a condo.
Yeah. And that's what's huge. I mean, that's the beauty of house hacking is you can live in a nicer area or a better unit than you could afford if you just got a condo or maybe a townhouse or something like that.
Yeah.
For new investors, how does house hacking kind of help people build their portfolio?
Yeah, for new investors, it's a great opportunity to buy specifically a multi-unit property, a small multi-unit property, right? A 2-unit, 3-unit, or 4-unit property. Those get conventional loans, which is great. So you don't need special financing. And then the second, third, and fourth unit that you don't live in can help you with your debt to income ratio.
Yeah.
And so that helps contribute income to your regular income as well. So it's a great way for them to start off. And then this is a strategy that it's a very rinse and repeat strategy.
Yeah.
You buy your first unit, live in it for 12 months, and after 12 months, buy another unit again as your primary, live in one of the units, rent the other units, and keep repeating it till you can or you want to. And every year that goes by, you add 4 additional doors to your portfolio. Quickly, like within a span of 3 years, you have 12 doors.
Yep.
And now you have 11 tenants and 1 primary unit. You keep doing it and you keep adding doors.
The beautiful thing, too, about doing it this way is you're only putting potentially as low as 5% down.
Right.
So you're keeping that cash in your pocket.
Right.
Which allows you to buy that second one and that third one and that fourth one or however many years you want to do this. The cool thing is when you move out, you do not get rid of that low owner-occupied financing interest rate.
Right.
And a lot of people don't realize this. When I explain this to people, they're like, okay, well, once I move out, then I lose that low interest rate that I got for being the owner occupant.
Yeah.
And the answer is no, you keep that in place. As long as you're there a year, that's kind of the bare minimum you can do. you're good. You can buy that next one and do it again and do it again. So it's a great way to, again, build that portfolio, keep adding and adding and adding. Yeah. And all along the way, you're minimizing your own expenses out of pocket too.
And you're taking all the appreciation as well on those properties. And so
all the appreciation, all the depreciation, all the taxes.
Yeah, exactly.
Like you're getting benefits both ways. Yeah. That's the beauty of real estate. Okay, so that's house hacking. Let's talk about the live-in flip strategy. What is a live-in flip?
A live-in flip is where an investor, and again, this works for new investors as well as seasoned investors. You buy a property that needs some work. Again, you buy it with maybe 5% down, and you make changes to the house where it adds a lot more value. You force appreciation. And then when you're done with all of the work on the house, now you have a house with very little money down that you can refinance into a longer term loan or pull money out potentially, and gives you a way to add equity right out the bat into the house you're living in.
Yeah. So basically you're buying a house that needs some work. You're fixing it up. You're living in it because it's your primary home.
Yep.
And by the time you're done with the remodel, it's now worth a lot more.
Yeah.
That's the goal, at least.
Right.
That's what you should do. Don't overpay for a house up front. You make money in real estate when you buy, not when you sell. That's a big
This is sweat equity.
Yes.
This is exactly what they talk about. Like this is how you generate sweat equity. And the good part in a live and flip is you are potentially buying a house with a lot of other customers or buyers don't want to buy.
Yeah.
Not everyone is coming from a mindset of doing the work.
Yep.
So if you're willing to go that extra mile, that'll pay dividends very quickly.
Yeah. And you get a better deal because, again, most buyers just want something done. They just want to walk in the door and not have to do anything. So if you're willing to put in that little bit of work, that will definitely help. One thing that's really cool about doing this too is the 2 and 5 rule.
Right.
You want to go over that real quick?
Yeah. So real estate has a few different strategies, tax strategies that investors can deploy. One is the 2 out of 5 rule, which simply states if I live in a house 2 out of the 5 years, doesn't have to be the continuous 5 years. It can be the first year and the 5th year, but as long as I'm physically there 2 out of 5, it's a primary residence. And once it's qualified as a primary residence as per IRS code, a single person can take up to $250,000 of gain tax-free.
Yeah.
A married couple can take $500,000.
It's insane.
Yeah. So if you buy a fixer, you force that appreciation, and then you live in it for a while, and market goes up, you are taking all of that gain without paying Uncle Sam a single dime, potentially.
Yes, exactly. I have loved doing this personally. I have many clients that have done this over the years. And you're basically remodeling your own house. And then after 2 years, you do it again. You buy another one. And you get up to, if you're married, up to $500,000 tax-free.
Exactly.
That's insane. Instead of paying almost 40% tax on that gain, you're paying zero.
Zero, yep.
It's massive. It's a huge, huge savings.
Yeah.
If you want to learn more about this, we also have another episode. Episode 114, that's where I interviewed Matt Bontrager of True Books. He is the most famous CPA on social media. I did a one-on-one interview with him, and he went over this. There were some cool tax strategies in there. In fact, he explained to me, which I did not know this, that you can actually prorate that. If you're only there for a year and a half, not the full 2 years, or even 9 months out of 2 years, you can prorate that gain.
That's pretty cool. Yeah.
It's insane. I had no clue.
Yeah.
No clue. So that's where, again, in real estate, there's so many different tax loopholes. You want to make sure that you have good people on your team to help you take advantage of the rules that are in place to benefit us.
Right. Yeah. Right.
Yeah. All right. So back to live and flips. How does one help investors, especially those that are just starting out?
Sorry.
Yeah, no, that's like, it's basically a great way to build capital. You're living in the property. We've kind of already covered this.
Right. I don't want to repeat myself, so.
Yeah, I'm not going to say it anyway. Okay. You ready?
Yeah.
All right. So when considering a live and flip, what type of property should investors be looking for?
Again, as we talked about it, right? Properties that you're looking for are houses that need work, but in nicer neighborhoods. So you're looking for the worst house in the best block.
Yep.
So identify your neighborhoods, identify your blocks, good school districts, and if there are properties that need work on in these neighborhoods, that is what you want to target.
Yeah.
And you want to go in again. Don't put 20-25% down. Try to put 5% down and make your cash work harder and stretch that dollar as much as you can so that you can then get a lot more equity at the back end.
Yeah. And again, if you don't sell it after 2 years or 5 years and you just want to keep it, that's where you could theoretically do a refinance where you refinance your loan, you pull some cash out. You could actually take all the money that you put into the house, so the down payment and all the rehab funds, take that all out, and you could keep that as a rental if it makes sense for you, and then use those funds to go do it again.
And again, and you keep repeating the strategy. Again, these strategies are great because they are not a one and done. You can keep repeating them as many times it makes sense for your situation. And you can mix and match. That's the awesome part about real estate.
Yeah. So let's talk about some of the downfalls, some of the challenges or risks with doing a live and flip. What are those?
The obvious one is you're living in a construction zone for a period of time, so there are inconveniences about that. You have to make sure that you don't have cost overruns, so you need to have a really good team and a really good handle on your construction cost. You need to be able to pivot sometimes. You find some unknowns when you're doing these kind of flip and flips. Always.
Every time you do a flip, you find unknowns.
And so there are going to be roadblocks. As long as you can kind of have a plan around it and keep moving forward, I think live and flips make a lot of sense.
Yeah. And the thing, too, is you don't actually have to be living in the property while you're doing the rehab.
Right.
You could buy it, get all the work done either up front or on the back end, whatever you want to do it. If you have a 2-year time frame, live in it first and then do the rehab at the end, or do it up front. Be out of the house and rent for a couple months, or staying, or live in your current house for a little while longer, and then do the work, and then move in and enjoy it for those almost 2 years, year and a half, whatever it is.
Right.
Yeah. All right. Let's talk about a way that you can supercharge a live and flip. This is, when you explain this, I was like, damn, that's super smart. How come I didn't? I'm doing DADUs, and I never even thought about this. And you're building DADUs and ADUs as well. So I get why you figured this out. So let's explain this.
So in Seattle and some other cities in Washington State and potentially outside of Washington State, allow any buyer or any homeowner to build another unit, potentially 2, in their backyard. So as long as the yard and the lot meet certain requirements, you can build what's called a detached accessory dwelling unit, or a DADU. And now, when you combine the live and flip with a DADU strategy, it really works because you can buy the house with the lot with 5% down. While you're working on the house, as you said, you're renting, you're working on the house for a year, you can get permits for the DADU done, and then also build a second unit in that backyard. And then when you move in, you have a rental unit next door, and you have your primary home right there. And so it really adds a lot more equity, and you're essentially making money out of dirt in the true sense, because you're building where there's nothing right now.
And when you do that, you do decrease the main house value a little bit because you're removing the yard and now you have a structure back there. But overall, whole property, you're increasing the value of the land by a lot. So it's everyone's not comfortable doing that, and if you're not, that's fine. But if you are, you're increasing your portfolio by quite a bit.
And again, in Seattle, it works a lot more because Seattle is one of the cities that allow you to sell it separately, refinance it separately. A year down, you wanna, I wanna refinance the house separately from the DADU. You can pull money out of both because live and flip has equity. The DADU has equity. You pull money out. Now you have potentially tax-free money in your pocket because it's still a loan. It's a refi. And you can deploy that for the next project or go on a good vacation.
Exactly. Let's talk about the actual costs involved with a DADU. How much does it cost to build one?
In Seattle, generally, it costs around $350 to $400 per square feet. You're building about 1,000 square feet, so round numbers, $350,000 to $400,000 to build one.
It sounds like a lot.
It sounds like a lot, but my kind of rule of thumb is anything north of downtown Seattle, if you have a DADU that is 1,000 square foot, you are potentially selling that for anywhere between $750,000 all the way up to $900,000, depending on finishes that you pick and the neighborhood you're in. So there's a lot more equity gain if you decide to build.
Yeah.
And that's kind of the supercharge factor of the DADU that comes into this picture.
Mm-hmm. Yeah, and you're almost doubling your money. Like often you are.
Yeah.
$350 to build, it's worth $700, $750, something like that. I mean, that doesn't suck.
Yeah.
And it takes maybe 9 months to a year.
Yeah. A year is the average. On the long side, it's going to take probably 18 months. On the short side, it could be as quick as 9 months.
Yeah.
So again, if you have a longer roadmap in mind and you kind of look just beyond the immediate 5-6 months, then there is a lot more money to be made.
Yeah.
Yeah.
Let's go over some actual numbers on this now. I know we just kind of did for the DADU part. So $350 to $400 a square foot. So $350,000 to $400,000 to build that. Let's give an example of maybe a house in North Seattle that you could buy that needs some work and it would work as a live and flip. What are we looking like average-ish cost?
So averages on a house that needs work in North Seattle would be, let's say, around $700,000 for round numbers. It needs, let's say, $100,000 worth of work. After you put in the work, the new value of that house after everything's fixed up is $900,000. So you have $100,000 in equity. Sounds great. It's a great starting point. Now, if you have a backyard where you can actually build a DADU, you spend another $350,000 to $400,000 to build that one, and that, let's say, gets appraised for $750,000, and so you have another $350,000 in that DADU.
Yeah.
So overall, now you have close to $500,000 of equity on your property itself.
Yeah. Which is crazy.
Yeah.
In like a year.
In a year.
Yeah. Not a bad way to earn some cash.
Not a bad way to start either.
Yeah. No. Great way to start. And you're helping people do this now on the team.
Yes.
Yes. So if you are looking to do this, if you are looking to do a live and flip or build a DADU or both, Varun is the guy to talk to.
Yeah.
We'll give you his email at the end. All right. So now that we understand the basics on the cost of building a DADU, how the heck do you fund these things? Where do you get the cash? Because $350,000 to $400,000, that's a lot of cash that not everyone has just sitting around.
Right. And so there are multiple ways to fund your DADU.
Okay.
So one is very straight and clear. You can get a construction loan once you have permits in hand. Banks will review it and give you a loan, and then you work with a contractor to build it out.
Yep. And we have contacts for this, so just let us know.
Yeah. The other way is if you have a previous residence, you can take a HELOC out on that residence, which is a home equity line of credit.
Yeah, we actually have an episode all about HELOCs, episode 50. You can learn everything you want to know about home equity lines of credit.
Yeah. And so on the lines of credit, a lot of people know about the home equity based line of credit. A lot of tech workers get stocks as part of their compensation.
Yeah.
And so what they probably don't know, or some of them do, is you can get a line of credit on the stock portfolio without having to actually sell that asset.
Yeah.
It's called a stock-based line of credit, and most of the big banks offer the solution. You just need to ask the question, and you can pull this money out, and it is usually a lower interest rate than a hard money loan or a construction loan. And so it's actually saving you a little bit of money on the holding cost as well.
Yeah.
But it's a great way to fund your DADUs, and you can pay it back when the DADU is built out and you refinance into a 30-year loan.
Yeah, that's awesome. The other thing you could do as well is, in order to sell a DADU, you actually have to condo it off. And I know that sounds weird because you think of condo, you're thinking like a big building that looks like an apartment building, and that is technically a condo. These DADUs are technically a condo too. We actually have an episode all about that. I know we refer to a lot of these episodes, but episode 122, it's all about condoization. We interviewed basically probably the leading expert in the state, Katie Sweden with Dimension Law. She's the one that creates thousands of these and has done just about more than anyone, if not the most of these in the state. So we interviewed her for a long time, and we went over the ins and outs and pros and cons of doing this. So once you do condoize your DADU and your house, you can actually then get a loan on each property.
Yep.
Which is huge, because then you could refi it into either a long-term loan once the DADU is built, or you could potentially get a construction loan just on the DADU build.
Yeah. And once the DADU is built, you can also get a DSCR loan, which is just based on the DADU without having to provide your financials.
Yep.
Right. So those are, again, different strategies of how to make DADUs work, because yes, the numbers are big, but the payout is big as well. And so you want to make sure you have the right strategies in place so that you can execute on your live-in plus DADU flip.
Yeah. And this, again, this is a lot we're going over very high level thinking right here, very high level strategies. You need to make sure that you have a good team to help you in these situations. We are here to help you, Varun and I. We can help assist with all this. We have all the contacts that you need to make these decisions and see which scenario works best for you. If you are in tech and you want to do that, whatever you called
Stock-based line of credit.
Stock-based line of credit. See, he came from the tech world. I did not. He knows these things. Then you can do that. And we have people that you can talk to in all these different departments. So,
and we'll run numbers, right? We'll make sure the numbers work. We'll not make an emotional decision. We want to make a number-based decision where there is a positive outcome at the end.
Yep.
Right?
Yeah.
So.
And we don't care which way you go. We don't get anything more or less depending on which route you go. We just want you to have the information so you can make that informed decision. That's what we're always looking to do.
That's right.
So when people are looking for potential DADU lots, what should they be looking for? What are kind of the red flags or things to stay away from?
Yeah. So just logically, when you're trying to build something, you need access. So look at lots that have an alley in the back or are corner lots, so you can actually get your equipment, your materials in the backyard. If you don't have access to the backyard, it really is not buildable at that point. So access is important. The other things that you need to look for is it's a flatter lot, not steep slopes. Steep slopes are difficult to build on, so watch out for those. Make sure your utilities are all on the lot or present, where you can connect both the units to the utilities fairly easily. And lastly, trees or other obstructions. You want to make sure you don't have a large tree in the backyard, because again, in Seattle and many other neighborhoods, you potentially would not be able to take down that tree, and that would just not allow you to build that DADU. So you want to make sure if there are trees there on the side of the lot where they don't impede construction or the footing of the new building.
Yep. And so there are definitely ways that we can assist you in figuring all these things out. In understanding, is this a good DADU lot or not? Is this a good live and flip property or not? That's why Varun's on the team now to help us figure that out, because there's been a lot of people over the years that have asked me to help them, and I try to help everyone, but I can't do it all myself because I'm also doing these things, and I'm only one person. I can't do everything. So that's why we brought on Varun. Varun's also doing these, and so he knows what he's doing. He's not just theorizing how to do it. He's actually doing it, and that's huge. So, Varun, thank you so much for coming on today. I hope and have a very strong feeling there's a lot of people that are going to get a lot out of this. If you have questions, if you want to reach out to Varun, his email is just varun@awesomenossum.com. That's VARUN @awesomenossum.com. That's it for today's episode of the Awesome in Seattle podcast. Thank you so much. We'll be back in another couple weeks with some more information to help you succeed in real estate. See ya.